In the heart of America's booming energy sector, a company rose from humble beginnings to become a titan of innovation and wealth. Enron began as a modest natural gas pipeline operator in 1985, born from the merger of Houston Natural Gas and Internorth under the visionary leadership of Kenneth Lay. Lay, a man with deep roots in economics and a belief in the power of free markets, saw opportunity in the winds of deregulation sweeping through the industry. As federal laws loosened controls on natural gas sales in the early 1990s, Enron shed its traditional role as a mere transporter of energy. It transformed into something bolder, a trader of commodities, a creator of markets where none had existed before. This was the dawn of a new era. Enron positioned itself at the forefront of a revolution, promising to bring efficiency and competition to a stagnant field dominated by regulated utilities. Lay surrounded himself with ambitious minds, men and women who shared his conviction that old ways were crumbling and that daring innovation would redefine the future. Among them emerged Jeffrey Skilling, a brilliant consultant from McKinsey, hired in 1990 to lead Enron Finance Corp. Skilling brought ideas that electrified the company. He advocated mark-to-market accounting, a method approved by regulators that allowed Enron to book projected future profits from long-term contracts immediately, rather than waiting years for cash to flow. This approach painted a picture of explosive growth, turning speculative deals into instant earnings on the books. Under Skilling's influence, Enron expanded rapidly. It ventured into electricity trading, water utilities, broadband services, even weather derivatives. The company became a darling of Wall Street, its stock soaring as analysts praised its forward-thinking model. By the late 1990s, Enron had grown into one of America's largest corporations, ranked 7th on the Fortune 500, with revenues exceeding $100 billion in 2000 alone. Employees flocked to Houston, drawn by lavish perks, stock options that seemed destined to make them millionaires, and a culture that celebrated risk-taking and intellect. The headquarters towered over the city, a gleaming symbol of success, where traders operated in a high-stakes environment reminiscent of a Wall Street floor, shouting bids and offers in a frenzy of deal-making. Yet, beneath this facade of unstoppable progress, seeds of fragility were taking root. The aggressive pursuit of growth demanded constant new ventures, each more ambitious than the last. To fuel this expansion, Enron needed ever-increasing stock prices to raise capital and reward executives whose compensation was tied to performance metrics. Skilling, promoted to president and chief operating officer, instilled a rank-and-yank system, where employees were graded ruthlessly, the bottom performers fired annually, fostering a survival of the fittest mentality. This culture bred intensity, rewarding those who pushed boundaries and delivered results no matter the means. Andrew Fastow, a sharp financial mind elevated to chief financial officer in 1998, became instrumental in sustaining the illusion. Fastow devised complex structures, special-purpose entities, that allowed Enron to move debt off its balance sheet while recognizing gains from transactions with these very entities. These off-balance sheet vehicles, bearing cryptic names like Raptors and Chuco, were designed to hedge risks and hide losses from failing investments. Banks and investors were enticed to participate, often with guarantees that protected them from downside, promises that ultimately circled back to Enron itself. As the new millennium dawned, Enron's ascent appeared inexorable. Its executives graced magazine covers as visionaries, Lay hobnobbing with presidents and policymakers, advocating deregulation as the path to prosperity. The California energy crisis of 2000 to 2001 provided a grim showcase for Enron's trading prowess. Deregulation in the state had created volatile markets, and Enron traders exploited loopholes with strategies bearing names like Death Star and Fat Boy, artificially inflating prices by withholding supply or creating congestion on transmission lines. Power plants were shut down under false pretenses, driving electricity costs skyward, blackouts rolling across the state as families and businesses suffered. Profits poured in from these maneuvers, bolstering Enron's image as the smartest player in the room. But the gains were fleeting, built on manipulation rather than sustainable value. Internally, cracks began to form. Some investments, like the international power projects led by Rebecca Mark or the broadband division, hemorrhaged cash without delivering promised returns. To mask these shortfalls, the financial engineering grew more intricate, dependencies on rising stock prices more acute. Enron's leadership convinced themselves, and the world, that complexity was sophistication, that opacity was necessary for competitive edge. The year 2000 marked the peak, Enron's stock reaching $90 per share, its market capitalization surpassing $70 billion. Lay, Skilling, and their inner circle amassed fortunes through options and sales, their wealth a testament to the company's supposed genius. Employees poured retirement savings into company stock, confident in the narrative of endless growth. Analysts, enamored with the story, rarely probed deeply, accepting assurances that the numbers, however convoluted, reflected reality. But reality was diverging. Questions lingered in quiet corners. A few journalists and analysts began scratching at the surface, wondering how Enron generated such profits with so little tangible asset base. The company's disclosures grew denser, footnotes longer, explanations more evasive. In February 2001, Skilling ascended to chief executive officer, Lay stepping to chairman, signaling continuity in the aggressive strategy. As summer approached, strains intensified. Broadband ventures faltered. International assets underperformed, and the California schemes drew regulatory scrutiny. Yet, the machine pressed on, driven by a conviction that momentum could overcome any obstacle. Enron embodied the exuberance of the dot-com era extended into energy, a belief that traditional rules no longer applied, that intellect and audacity could rewrite economics. This was the empire at its zenith, a colossus striding across the American landscape, reshaping industries and influencing policy. It seemed destined to endure, a model for the future of capitalism. But empires built on shifting sands face inevitable reckoning. The higher the rise, the deeper the shadows cast, concealing vulnerabilities that, once exposed, would unravel everything. The summer of 2001 carried an uneasy stillness beneath the surface of Enron's gleaming empire. Jeffrey Skilling, now at the helm as chief executive, projected unflinching confidence in every public appearance. Earnings calls brimmed with assurances that the business model remained sound, that broadband would soon explode with value, that international assets were merely in a maturation phase. Stock analysts, still captivated by the narrative of transformation, largely echoed the optimism. Yet inside the towering headquarters in downtown Houston, pressure mounted like storm clouds gathering on the horizon. Andrew Fastow's financial structures had grown into an intricate web of partnerships, each feeding into the next, each reliant on Enron's own stock as collateral. The Raptors, those hedging vehicles meant to protect against declining investments, were now themselves underwater. To stabilize them, more entities were created, more stock pledged, more debt concealed. The circle tightened. As long as the share price climbed, the system held. But any sustained decline threatened a cascade of obligations that Enron could not meet without revealing the true extent of its leverage. In August, the first visible fracture appeared. Skilling, the architect of Enron's meteoric rise, abruptly resigned after only 6 months as chief executive, citing personal reasons. The announcement stunned markets. Shares dropped sharply. Analysts scrambled for explanations, while Lay reassured investors in conference calls that nothing fundamental had changed. He resumed the role of chief executive, projecting calm, promising that the company's trajectory remained upward. Behind closed doors, however, executives understood the fragility. Skilling's departure removed the primary champion of the aggressive culture, leaving Lay to navigate mounting skepticism. Whispers began to circulate. Sharon Watkins, a vice president in the finance group who had once worked directly under Fastow, sensed the deepening peril. In anonymous notes and then a direct memo to Lay, she warned of accounting improprieties that could cause the company to implode in a wave of scandal. She pointed to the related party transactions, the conflicts of interest inherent in Fastow managing entities that dealt with Enron, the potential for billions in losses hidden from view. Lay listened, consulted attorneys, directed investigations, but the responses remained measured, constrained by the need to avoid triggering immediate collapse. Outside the company, a handful of voices grew louder. Bethany McLean, a reporter at Fortune magazine, had published a piece in March titled, "Is Enron Overpriced?" questioning how the company generated such lofty profits with so little transparency. The article noted the opacity of disclosures, the difficulty in tracing cash flows, the reliance on mark-to-market gains that seemed detached from reality. Enron's response was swift and dismissive, executives calling the piece misguided, analysts who supported the stock labeling it naive. Yet the questions lingered, planting seeds of doubt in institutional investors who had once bought the vision unquestioningly. Jim Chanos, a prominent short seller, had begun betting against the stock earlier in the year. His research uncovered the disconnect between reported earnings and actual cash generation. Enron's operating cash flow paled beside its proclaimed profits, a red flag that traditional metrics could not reconcile. Chanos shared his findings with journalists and other investors, amplifying the quiet chorus of concern. Still, the broader market remains buoyant, the tech wreck of 2000 largely behind it, and Enron's political connections offered a shield. Lay's relationships reached into the highest levels of government, friendships with the Bush family, contributions that influenced energy policy. As autumn arrived, the strain became palpable. The September 11th attacks shook markets nationwide, but Enron's troubles ran deeper than temporary sentiment. Broadband swaps with competitors failed to materialize the anticipated value. Blockbuster video-on-demand deal collapsed without revenue. International projects in India and Brazil bogged down in disputes and underperformance. To shore up confidence, Enron announced a $1.2 billion stock repurchase program, signaling belief in its undervaluation. Yet the move required borrowing, adding to the hidden burdens. October brought the first admissions of trouble. Enron reported third-quarter results that included a $1 billion charge related to failed investments and the unwinding of certain partnerships. The company revealed that Fastow had earned millions managing the off-balance sheet entities, a disclosure that ignited outrage over conflicts of interest. Shares plunged further. Regulators at the Securities and Exchange Commission opened an informal inquiry. Journalists pressed harder, uncovering layers of complexity that defied straightforward explanation. Lay held town hall meetings with employees, urging faith in the franchise, insisting that liquidity remained strong, that the core trading business thrived. Thousands watched his broadcasts, their retirement accounts heavily weighted in company stock through 401k plans that matched contributions in Enron shares. The message resonated with many who had lived the boom years, who believed in the genius surrounding them. Dissenters were marginalized, their concerns dismissed as lack of vision. Fastow was removed as chief financial officer, replaced by a steady hand from the old pipeline days, but the damage spread. Rating agencies placed Enron's debt on watch for downgrade. A single step into junk status would trigger provisions in the partnerships, forcing repayment demands that the company could not satisfy. Banks grew nervous, lines of credit tightened. The machinery that had propelled growth now operated in reverse, each disclosure accelerating erosion of trust. By November, the endgame accelerated. Dynegy, a rival energy trader based nearby in Houston, entered negotiations to acquire Enron in an all-stock deal valued at over $9 billion. The merger promised salvation, a lifeline that would absorb the debts and restore credibility. Employees exhaled momentarily, executives worked around the clock on integration plans. But due diligence revealed deeper holes than anticipated. Hidden obligations surfaced, guarantees that extended far beyond previous admissions. Dynegy's leadership wavered, then withdrew, terminating the agreement and forfeiting a $350 million breakup fee that offered only fleeting respite. The withdrawal proved fatal. Credit agencies slashed Enron's rating to junk on November 28th. The cascade began. Partnership creditors demanded repayment. Cash reserves evaporated. Trading counterparties refused new deals without collateral. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, the largest in American history at that time, with assets of $63 billion and liabilities that dwarfed comprehension. $74 billion in market value had vanished since the peak, fortunes erased, pensions devastated. The fall was not merely financial. It was a shattering of belief, a moment when the promise of a new economy revealed its underbelly. Thousands of employees, many lifelong, lost jobs and savings in a single stroke. Suppliers and partners reeled from unpaid bills. The energy markets Enron had helped shape froze in uncertainty. In Houston, the headquarters stood silent, a monument to hubris now surrounded by shock and betrayal. What had seemed an unstoppable force revealed itself as a house of cards, sustained by deception and denial. The reckoning had arrived, swift and merciless, exposing not just one company's failings, but vulnerabilities woven into the fabric of American capitalism at the turn of the century. The bankruptcy filing on December 2, 2001, sent shockwaves far beyond the glass walls of Enron's Houston headquarters. Overnight, a company that had symbolized the triumph of American ingenuity became the emblem of corporate deceit on a scale previously unimaginable. 20,000 employees woke to a future stripped bare. Retirement accounts that had swelled with company stock through years of matching contributions now held worthless paper. Dreams of early wealth, of homes and college funds built on the promise of endless appreciation, dissolved into despair. Layoffs followed swiftly. Entire divisions shuttered. Loyal workers escorted from buildings they had helped construct into legend. Creditors circled, picking through the wreckage of a balance sheet riddled with holes. What had been presented as modest debt now revealed itself as a mountain. Tens of billions shifted offshore or buried in partnerships that collapsed like dominoes once the parent company faltered. Banks that had eagerly financed the structures faced massive write-downs. Arthur Andersen, Enron's longtime auditor, one of the big five accounting firms, found itself entangled in the fallout. Documents shredded in Houston and elsewhere suggested obstruction, eroding trust in the gatekeeper meant to safeguard investors. Congress moved with rare speed. Committees in both the House and Senate scheduled hearings, summoning executives to account for the catastrophe. The nation watched as Kenneth Lay, Jeffrey Skilling, and Andrew Fastow appeared before cameras, their testimonies a study in evasion and defiance. Lay invoked the Fifth Amendment, refusing to answer questions that might incriminate him. Skilling,
combative and unyielding, insisted that Enron's collapse stemmed from a run on the bank triggered by short sellers and sensational media, not from any fundamental flaw in the business or its accounting. Fastow, already cooperating with prosecutors, remained silent at first, his later plea bargain revelations still months away. Investigators descended. The Justice Department launched a criminal probe, assembling a task force dedicated to unraveling the fraud. The Securities and Exchange Commission pursued civil charges. Bankruptcy examiners pored over millions of pages, reconstructing transactions that spanned continents and years. What emerged was a portrait of systematic deception. Mark-to-market accounting, once hailed as innovative, had been stretched to recognize profits from deals that never generated cash. Special-purpose entities, intended for legitimate hedging, had become vehicles for self-dealing, Fastow personally profiting while shielding losses from shareholders. The human toll deepened with each revelation. Former employees spoke of a culture that punished caution, where raising concerns meant risking career suicide. Whistleblowers, like Sharon Watkins, gained national attention. Her memo to Lay elevated to prophetic warning. Yet many inside the company had believed the story, convinced by the soaring stock and the accolades that their work represented the future. The rank-and-yank system had silenced dissent, promoting those who embraced aggression over those who questioned risk. Arrogance had permeated every level, a conviction that Enron operated above conventional rules because it was simply smarter. Wall Street confronted its complicity. Analysts who had maintained buy ratings until weeks before the bankruptcy faced scrutiny for conflicts of interest. Investment banks that structured the partnerships and earned hefty fees now defended their roles as standard practice. Credit rating agencies explained delayed downgrades by pointing to the complexity of disclosures, admitting that opacity had masked reality until too late. The ecosystem that had fueled Enron's rise now shared in the blame, a network of enablers bound by incentives to overlook warning signs. In the spring of 2002, the first indictments arrived. Lower-level executives and bankers pleaded guilty, agreeing to cooperate in exchange for leniency. The spotlight intensified on the top tier. Fastow, facing decades in prison, struck a deal in 2004, pleading guilty to conspiracy and providing detailed testimony against his former colleagues. His accounts painted a vivid picture of pressure from Skilling and Lay to meet earnings targets at any cost, of structures designed explicitly to mislead investors while enriching insiders. The trials became national theater. In Houston, federal courtrooms filled with spectators as prosecutors laid out the case against Skilling and Lay in 2006. Evidence included emails celebrating manipulative trading strategies in California, recordings of executives mocking regulators, documents showing direct approval of improper transactions. The defense argued that no laws were clearly broken, that aggressive accounting fell within gray areas exploited by many corporations. Skilling maintained his innocence with fierce conviction, portraying himself as a visionary betrayed by subordinates. After months of testimony, the jury deliberated. On May 25, 2006, verdicts landed like thunder. Skilling guilty on 19 counts of fraud, conspiracy, and insider trading. Lay guilty on all counts in his separate trial. Sentencing promised decades behind bars. But fate intervened. On July 5th, 2006, Kenneth Lay died suddenly of a heart attack while vacationing in Colorado, vacating his convictions and leaving a nation divided over whether justice had been served or denied. Skilling received 24 years, later reduced on appeal, beginning a long incarceration that continues to spark debate. Fastow served 6 years, emerging to speak on ethics and the dangers of unchecked ambition. Anderson, convicted of obstruction, surrendered its license, collapsing a century-old firm and reducing the Big Five to 4. Thousands of civil lawsuits settled for billions, drawn from insurance policies and bank coffers, though victims recovered only fractions of losses. The scandal reshaped the landscape of American business. Public outrage demanded reform, and Congress delivered the Sarbanes-Oxley Act in July 2002.
Signed by President Bush, who had once called Lay Kenny Boy, the law imposed stringent new rules on corporate governance. Chief executives and financial officers now certified financial statements personally, facing criminal penalties for falsehoods. Audit committees gained independence. Internal controls required rigorous testing. Whistleblower protections strengthened. The Public Company Accounting Oversight Board arose to oversee auditors, ending self-regulation that had failed so spectacularly. Markets adapted. Transparency became a watchword. Disclosures expanded. Off-balance sheet financing curtailed. Investors grew wary of complexity marketed as sophistication, demanding clearer links between reported profits and cash generation. The energy trading sector consolidated, survivors adopting more conservative models. California's electricity market underwent redesign, closing loopholes Enron had exploited. Yet the Enron saga endures as more than a cautionary tale of one company's fall. It exposed the perils of unchecked deregulation, of incentives misaligned with long-term stability, of a culture that prized short-term gains over sustainable value. The $74 billion evaporated from the market represented not just shareholder wealth, but a broader erosion of trust in the institutions that underpin capitalism. Pensions destroyed, lives upended, faith shaken in the promise that markets, left to innovate freely, would always serve the greater good. In the years that followed, echoes of Enron reverberated through subsequent crises. The financial meltdown of 2008 revealed similar patterns of leverage hidden in complexity, ratings inflated, risks underestimated. Observers drew parallels, noting how lessons learned in theory often faded in practice when prosperity returned. The human elements persisted, ambition unchecked, oversight weakened, accountability deferred until catastrophe forced reckoning. Enron's legacy lingers in boardrooms and classrooms, a reminder that extraordinary success can mask extraordinary vulnerability. The company that sought to redefine energy forever altered something deeper, the understanding of how power, when concentrated and unexamined, can corrupt even the most admired enterprises. What began as a story of ascent became an epic of hubris, deception, and eventual exposure, a chapter in American history that continues to instruct and warn. 2 decades have passed since the towers of Enron crumbled, yet the ground it scorched remains visible across the American landscape. The fraud that erased $74 billion in market value did not vanish into history. It embedded itself into the architecture of modern capitalism, a permanent scar that reshaped laws, markets, and the very language of trust in corporate America. Sarbanes-Oxley endures as the most significant piece of financial legislation since the Great Depression, its requirements woven into the daily rhythm of public companies. Executives sign certifications each quarter under threat of prison. Auditors rotate, internal controls are tested and documented with religious precision. The cost runs into billions annually, yet few dare argue for repeal. The memory of Enron lingers as justification, a reminder that vigilance has a price worth paying. Energy markets themselves transformed irreversibly. The wild deregulation experiment of the 1990s gave way to tighter oversight. California's restructured electricity system,
once a playground for Enron's trading schemes, adopted caps and safeguards that prioritized reliability over pure market forces. Federal regulators expanded authority, monitoring trading platforms with tools sharpened by the lessons of Death Star and Fat Boy. The merchant energy sector consolidated dramatically. Survivors like Dynegy and Calpine emerged leaner, focused on tangible assets rather than speculative trading empires. The dream of energy as a frictionless commodity, traded like stocks in endless volume, faded into cautionary anecdote. Corporate culture absorbed subtler changes. The rank-and-yank performance system Skilling championed fell into disfavor, replaced by models that value collaboration over cutthroat competition. Whistleblower programs multiplied, hotlines and protections mandated by law, rewarding those who speak rather than punishing them. Boards of directors awakened to their fiduciary duty. Audit committees staffed with financial experts, independence no longer optional. The era of celebrity chief executives, gracing magazine covers as infallible visionaries, gave way to greater scrutiny. Compensation tied overwhelmingly to stock performance came under question. Clawback provisions now standard to reclaim gains built on false premises. Higher education incorporated the saga into curricula. Business schools teach Enron as the definitive case study in ethics, accounting, leadership, and governance. Students dissect the mark-to-market decisions, the special purpose entities, the shredded documents, searching for moments when intervention might have altered the trajectory. The story serves as a morality play and technical manual, illustrating how incentives distort judgment, how complexity can conceal rather than reveal. Graduates enter the workforce carrying the caution that brilliance, untethered from integrity, leads inexorably to ruin. Popular culture preserved the scandal in books, films, and plays. The smartest guys in the room became required reading. Its title, ironic shorthand for hubris. Documentaries replayed the footage of Lay addressing employees, Skilling testifying with defiant certainty, Fastow recounting his inventions under oath. The narrative captivated because it contained every archetype: the rise from obscurity, the intoxicating ascent, the hidden rot, the spectacular fall. Audiences watched not just for schadenfreude, but for understanding of how ordinary ambition, amplified by opportunity and enabled by systems, could produce
extraordinary deception. The human aftermath unfolded quietly over years. Former employees rebuilt lives, many leaving Houston, some testifying in trials, others starting small businesses or entering public service. Pensions partially restored through settlements provided cold comfort against dreams permanently altered. Sharon Watkins continued speaking on corporate courage, her warnings validated, yet bittersweet. Jeffrey Skilling, released in 2019 after serving 12 years, returned to energy ventures on a smaller scale, his name forever linked to the catastrophe he helped create. Andrew Fastow lectures on the perils of rationalization, his cooperation shortening his sentence, but not his accountability. Financial crises that followed inevitably drew comparisons. The 2008 mortgage meltdown revealed parallels in hidden leverage, inflated ratings, and systemic denial. Observers noted how Enron's off-balance sheet debt foreshadowed the shadow banking that nearly toppled the global economy. Reforms born of that later crisis built upon Sarbanes-Oxley foundations, layering stress tests and capital requirements atop governance changes already in place. Each episode reinforced the pattern. Prosperity breeds complacency. Innovation outpaces oversight. Risks accumulate until exposure becomes unavoidable. In the broader sweep of American history, Enron occupies a distinct place. It marked the boundary between the exuberant 1990s and the sobered new century, the moment when faith in unchecked markets reached its apex and began its retreat. The scandal exposed the limits of deregulation as ideology, demonstrating that freedom without guardrails invites exploitation. It revealed how political influence, cultivated through contributions and access, can delay reckoning, but not prevent it. Most profoundly, it illustrated the fragility of trust as the essential currency of capitalism. When investors, employees, and citizens lose confidence that reported numbers reflect reality, the entire edifice trembles. Today, in an age of cryptocurrency volatility, meme stock frenzies, and artificial intelligence promises, echoes of Enron resonate anew. Complex financial instruments proliferate. Valuations soar on narratives rather than cash flows. Charismatic leaders command followers willing to suspend disbelief. Regulators strain to keep pace. Lawmakers debate the balance between innovation and protection. The temptation persists to view rules as obstacles rather than safeguards, to celebrate opacity as competitive advantage. Yet the memory of Enron serves as counterweight. It reminds that extraordinary claims demand extraordinary evidence, that sustained success built on incomprehensibility often conceals unsustainability. It teaches that cultures rewarding aggression without accountability breed eventual catastrophe. Above all, it affirms that no enterprise, no matter how admired or influential, stands above the laws of economics or ethics. The higher the ascent, more devastating the fall, when foundations prove hollow. America moved forward from the wreckage, stronger in oversight, wiser in skepticism, tempered by the knowledge that progress requires vigilance. The $74 billion fraud did not destroy faith in markets, but refined it, demanding greater transparency, accountability, and humility. Enron sought to change the world through audacity and invention. In the end, it succeeded. Not in the way its leaders imagined, but in forging a more resilient system from the ashes of its ambition. The story endures not as tragedy alone, but as turning point, a chapter that altered the trajectory of American capitalism forever. The empire that rose from Texas pipelines and fell in a Houston courtroom left behind more than ruins. It left a legacy of lessons hard-earned, reforms hard-won, and a perpetual warning etched into the national consciousness. Greatness unchecked becomes hubris. Innovation without integrity becomes fraud. And even the smartest in the room can prove catastrophically wrong.